Hello, everyone. Hope you're doing well. What a fascinating week on global stock markets, especially the last 2 days of trading. A little bit of panic that looks a little bit too familiar. It looks a little bit like 2008 or the 2020 events, the pandemic. Let me just get that title screen out of the way and let's have a look at the charts because it's quite interesting what's happening. Um, Let me just make sure we're all recording okay. Yep, everything looks fine. So let's start, of course, with the US market, the S&P 500, and we're looking at the daily chart here. And if you've watched my previous videos, we've talked about how expensive these markets were prior to the crash. I've drawn plenty of lines like this before, showing the uptrend, the breaking of the uptrend. The classic technical action, you get the break of the uptrend, return to the scene of the crime, the rollover, and of course well, really a triple top there with negative divergence on the momentum indicators. We looked at that in previous videos. In fact, I just looked back and saw that I did a video in late January, the day after that peak, and we talked about this charting action straight out of the textbook. So let's look at what's happening now rather than what's happened in the past. Um, we can see the breakdown, and you've got this sort of this flagpole and then this little what you call a bear flag. That's very bearish price action. So not surprising that there was a further spill. You can see once there was a little bit of consolidation, once it broke down from the bear flag, little touch underneath, just return to the scene of the crime, and then of course quite an aggressive spill. But if we go back just a little bit, maybe a year ago. We're looking at the 18th of April there. So almost a year ago, or sorry, 19th of April. You can see that's a major low and also very close to a key psychological price of, the 5,000 level on the S&P 500. Obviously, these round numbers are quite significant, and I would suggest that I would expect some short-term bounce here. Now, of course, I can't give advice on an open YouTube video, but I can tell you what I'm doing, what my clients and I are doing. If you watched my previous videos, I talked about how we had a lower allocation to stocks while they were at or near all-time record highs. And we were sitting and we had larger positions in bonds, which have gone up. We had some gold, and we were in stock market funds, but covered call funds, so high income funds, because we felt stocks were expensive, but obviously you don't want to sit 100% on the sidelines. So we have taken a little bit of a hit on that, but what we're doing now is I'm seeing this and thinking that I'm going to start. My clients and I will probably start selling a little bit more of our bond funds that have gone up, and then looking at some regular index funds or some more growth orientated funds rather than the high income funds. Now that we've seen from the really the 19th or 20th of February, we've seen a over 17% decline, and of course very accelerated. Now, the RSI has made a new low, but we can see there is a little bit of positive divergence potentially starting to form, but I will acknowledge that it's far too early to call that, still catching a falling knife. But I would expect there's probably going to be some buying support around this level, at least a short-term bounce, given that it is a key previous low and it is an important psychological price barrier, the 5,000 level. And if we go back to weekly chart, we can see there was a major high in January of 2022. And if we bring that across, it's not much lower than that previous low as well. It's around the 4,800 level. So these are, remember, in my opinion, the most important thing for a market on a chart are key previous price levels. So that don't ignore that level. Yes, we could keep crashing. This could be a big freak out crash, but let me show you something that's a little bit, we talked about things being familiar. Let's go back to what happened in 2020. And apologies, I'm going to have to scroll through on this chart a bit. So if we go back to what happened in 2020, and funnily enough, it was almost the exact day in February, 19th or 20th of February, the same thing that happened this year in 2025, although I think that's just a coincidence. I don't think that these events are planned or staged, but it is. Let's have a look at what happened 5 years ago. Markets peaked, all-time record high, right? And it's hard to see on this chart, but there was, in fact, why don't we go back and have a look at what happened previously? So you can see the run up. Um, in fact, let's just look at the crowd. Let's not spend too much time on this. You can see that from the 20th of February to the 24th of March, so roughly 5 weeks, or maybe a little bit less than 5 weeks, there was a 35% sell-off in stock. So it was a larger sell-off than what we've currently seen. But have a look at how quickly it bounced. I mean, you didn't even get a MACD divergence signal. You did get some positive divergence on the RSI, plus the fact that the market had declined 35% in 5 weeks. Central banks, like the Federal Reserve, in my opinion, will work hard to prop up stock markets. They serve the interests of Wall Street and the commercial banking cartel. Um, I think they'll prop things up, and we're seeing the bond market start to price that in with interest rates. Up until late trading on Friday, interest rates were collapsing and bond prices have gone up. But have a look at this. If you bought the low on the 23rd of March, by the time you got to 8th of June, not that much longer, not that far away, you're up 47% and you were almost back to the all-time record high. And then, of course, by August, within 5 months, the US market had recovered all of its losses. And then by September, it had actually made a fresh all-time high. Now, I'm not suggesting that's going to happen this time. I'm just saying I see too many people sitting out saying, this is the crash, this is it. And they seem to be ignoring the fact that central banks can prop things up whenever they choose to. Now, they haven't done so yet, but they can do that. But I just wanted to point out that, we've seen crashes like this before. And what happened? The market crashed. Central banks slashed interest rates. They printed trillions of dollars, invented trillions of dollars in their computer, and they propped things back up. And that was during COVID. I mean, keep in mind, we're in a global lockdown essentially for, a year or two, depending on which country and how you want to measure it. And even as we were in lockdowns, supply chain problems, etc., stock market still pumped higher, made a new all-time high, because stock markets are not based on fundamentals. They're based on, in my opinion, the most important factor is what are central banks doing to manipulate the market, or governments, let's say governments manipulating the market, central banks, how much money are they printing? That's what determines where the markets go. Anyway, I've spent a little bit too much time ranting about that, but I wanted to show you the comparison. And if we look at the NASDAQ, the US market, sorry, the tech index, similar sort of thing. We saw the top. That was very obvious that there was a top being put in, and you can see the little consolidation there. This is a weekly chart now. You can see the negative divergence on the way up. We know that this is a sign that the uptrend is running out of steam. Of course, that uptrend uh, got quite out of hand, in my view. Let's shift to a daily chart, a 1 year chart, and again, we see the same sort of thing. There's a little bit the potential positive divergence forming. You've got these major lows here. So that's the low from really a year ago, from April 2024, right? And we're almost there. And these previous levels are going to be key. In fact, the NASDAQ is right at the low from August last year. So the candle came all the way down to touch that low. And again, you see the same thing, although, you know, this sort of flagpole, flagging action, breakdown, little retest, and then down to that low. So I am by no means suggesting that this is the bottom. I don't know if this is the bottom. I just know that this is a key previous price level, and we've seen a significant sell-off from the 19th of February until today, a 21% sell-off. That's a very significant sell-off in a short period of time. So that tells me it's appropriate, especially given that the Nasdaq's declined 21%. Meanwhile, US government bonds have gone up about 5% roughly in the same time, and roughly the same time period. So if we've got bonds that have gone up 5%, stocks down 21%, that's a 26% performance differential. So it makes sense to sell a little bit of the bonds and put it over into stocks. And that's, again, not advice to you. That's what my clients and I will be looking to do. And you can see the flag a little bit better. This is a Nasdaq futures chart. You can see, so the futures trade 24 hours, and you can see the flagpole and the flagging action a little bit better. This is, again, straight out of the textbook. You get the sell-off, the flagpole, the bear flag, and then the spill, and down it goes. And again, those lows are there as well. So let's just have a quick look at the Russell 2000, which is US companies, 2000 smaller cap companies. So, no Nvidia, Facebook, Alphabet, which is Google, that sort of stuff. No Apple, Microsoft, all that. Smaller companies, but obviously not small relative to a small business. Smaller companies relative to the megacorps, the multi-trillion-dollar Microsofts. Now, if we look at the Russell 2000 index, we can see it peaked actually peaked on the 25th of November. Um, Funnily enough, all this talk about how Trump was going to make things better for American companies. Well, this is an index that measures regular sized American companies, excluding Apple and Microsoft, and they pretty much peaked in price on the day that when was the election? The 20, is it 21st of November? It's late November. So it was almost the day that Trump got elected. This index of US companies peaked. Remember, everyone thought he's going to make everything better. Oh, Trump's in now. No, he's not going to make everything better because those companies are down nearly 26% in price. They've had a massive sell-off. And again, we actually are seeing some positive, assuming there's no further sell-offs through the week. We are seeing some positive divergence forming on the momentum indicators. We've seen a very significant sell-off. If we go to a yearly chart, a 5-year chart, we can see that again. So that was the COVID crash. Now, during those stocks peaked on the 20th of February, they declined 41%, so they're a little bit more volatile, and you can see the recovery. Look at how quick the recovery was. It only took until the end of 2020, so about 9 months to get all the way back to be up 70% if you bought the low to get back to the all-time high, and then of course went on to make another all-time high. Now, funnily enough, the all-time high was in November of 2021. It hit the exact same level again. Remember what I talked about earlier? An all-time record high price level is a very significant price level, and it hit that exact level again, which is not a coincidence. And then, of course, it hit that level when Trump was elected. These things are not a coincidence. This trading action is not a coincidence. Now we've seen a significant sell-off, but have a look. You've got the high from 2018. You've got the high from just before the COVID crash. Have a look at all that activity. Let me just delete that so we can see things a little better. Have a look at all this buying support here in 2022, 2023. Now, it did spend a few weeks below those levels, but we're right at that level again. So this would be, as again, these are significant previous price levels, which I think are the most important things on the chart. And while they're very simple, they're one of the most important things to look at when you're trying to gauge, hey, is it time for me to add a little bit of allocation? And this is why I'm now shifting away a little bit from buying covered call funds and looking at traditional index funds or what you might deem a growth fund. So for my clients and I, we're going to buy some of this. Now, I can't say which particular product, but it's one that's heavily allocated to this with some other quality international companies that have been filtered for certain criteria. Um, Please reach out privately if you want to discuss. I'm not trying to hide it. I'm just making sure I do things by the book, and we can't be giving advice if I don't know your personal circumstances. So this is just more so for charting to see what the trends are and just to be transparent and let you know what I'm doing for me and my group of clients. So interesting chart there. Now, what I would like to show you is the NVIDIA chart because I've showed this in some previous videos and I've kept all my notes on there, so I won't draw the notes live, but I just wanted to again show you the price action. You can see rising wedge. So this is a 2-day chart now. So this goes back to January 2024 when I would say the uptrend really sort of took off when it broke out. So Nvidia broke out at this level, and in my judgment, this is where the raging uptrend started, the mania really, and Nvidia went up 217% in the space of a year. I don't think that move was justified. I've talked about it to clients. I've talked about it in previous videos. I thought it was way overdone. And look at this. It's just straight out of the textbook. You've got a rising wedge pattern. Rising wedge patterns are generally bearish patterns, sell patterns. Textbook rising wedge patterns with the touches all the way up. You can see, you don't have to be a charting wizard to see it. You can see when Nvidia made its first high, the MACD and RSI peaked, so the momentum indicators peaked. You got negative divergence, which is generally a sell signal or a sign that the uptrend is losing momentum. We saw, there's so much going on in this chart. You can see the previous highs from the middle of 2024 were very significant. The price did briefly break above there, but look at how many times it bounced around in that trading range at around $132. A double, triple, quadruple top. I mean, if you want to zoom in, you could call that a top, a top, a top, a top. So not even a triple top, but a quadruple top. Previous highs being respected. And then, of course, look at that huge red candle there. Once the market decided this trend was over, bang, smash through, big red candle, and then what do we see? I say it all the time, return to the scene of the crime. So it found some support, return to the scene of the crime, touch the uptrend line, sells off, finds support, a little bit of buying support at the previous low there, and then goes, bounces around there for what, a week or two, and then the spill out of that now, and Nvidia is now at $94 and is down, from the record high of 153, it's now down 38% in price. So that's a pretty significant sell-off. I don't touch individual companies. I'm not giving any recommendation other than to say I'm just showing trends in the markets and have a look. You've got these previous highs from March 2024, April 2024, which then was with that. Once it breaks out, it returns to the scene of the crime, respects the previous high as the new low, and then look at where it's at now. So again, you would say, now I'm not buying this, but you would say this would be consistent with what I'm seeing in general stock markets, in the broader index. Nvidia is at a technical trading buy level, but that's not me saying to buy. I'm just saying like Nvidia supports what I said earlier in the video. Now, the Aussie market has not had a chance to trade because we're looking at how the US markets closed on Saturday morning in Australia time. So I'm not going to look at the regular Australian index, but what I will do is look at a derivative product, futures, basically Australia. It's the Aussie market, but it was able to trade through Friday night and Saturday morning. So let's have a look at that, and let's have a look at a 1 year chart. And we're going to see again the same thing. Aussie market all-time record high. You've got the flagpole, the bearish flag, same thing we saw on the US market, and then the spill out of the flag. And the Aussie market is now down from the peak on the 13th of February. So the Aussie market peaked a little earlier than the US market. It's down 15% now. So all of the gains for this financial year have been wiped out. And if we go back to where was the Aussie market at on 28th of June, where did it close? Closed there and down 5% now for the financial year, although things can change on Monday, of course, but that's where we're at right now. But if we go back to a 5 year chart, same thing with the Aussie market. You had the COVID crash, the 35%, and then, you know, these markets can be propped up by central banks. And we saw the Aussie market took until April 2021. So it took a bit longer because in Australia, uh, sorry to put the tinfoil hat on a bit, but I think the government and the Reserve Bank of Australia is focused on keeping the real estate hyper bubble propped up. Um, and so less focus on the stock market, more focus, or whether it's focus on the stock market or just a byproduct of how our economy is so leveraged to real estate, to residential property. I think probably a lot of the money that would normally flow into the stock market went into the real estate hyper bubble, propping that up. That's a topic for another video, but I think it's causing a lot of damage to Australia. And you can see that was the high in February 2020, and the Aussie market is almost back. But have a look at how significant that level is now. I know it's not quite there yet, but it's within a few percentage points, and you can see previous all-time record high in 2020, and you can see the market recovered. It respected it for a little while, broke above, but look at that, bouncing, bouncing, bouncing. Look at how much activity. Then we had a sell-off in 2022, returned to the scene of the crime. Look at that, holds the low. Look at how much activity is at this level. So this level just above 7,000, around this sort of 7,100 to 200 zone. It's a very key price level for the market. So again, for me, this is the level where I'm going to, my clients and we're going to, and we already have started, and I did start a little bit too early, increasing our allocation to stocks as opposed to bonds. And that'll depend on, for me, looking after or advising people on some of their money, generally on their superannuation. It's going to look at, do they have lots of bonds? Are the bonds at enough of a profit? Does it make sense to switch things around? Obviously, it's a little bit different for each client. Everyone has different risk tolerance, different amounts of money to invest. They might need the money in 6 months' time. So you can't invest that money just in case because you don't know what's going to happen in the next few months. But you can see again, we're hitting our first very key long-term significant levels on the Aussie market. Now, I wanted to show you something about the tariffs and about, so Trump has slapped 34% tariffs on China and 24% on Japan. I'm just using this as a comparison. And China has a massive, so China sells $295.4 billion more stuff to, um, sorry, let me just pause that for one sec. Like, okay, that should be back going now. My apologies for your technical glitches. I'll work through this. So what I wanted to show you, I guess, was that the Chinese market, so this is the Chinese market peaked now. It's doing its own thing, right? It had a massive spike in late 2024 when the Chinese announced some massive money printing stimulus programs. Of course, as I talked about earlier in the video, when governments announce stimulus programs and print money, they can make stock markets go up 35% in the space of a few days or weeks. And these are not good things, but this is what governments do, or it's a consequence of what, or byproduct of what they do. But the Chinese market well, on the 20th of February when US and Aussie markets peaked, or in February 13th when the Aussie market peaked, have a look at that. The Chinese market is basically the same price, and from the high this year, in fact, let's have a look if that is in fact the high from this year. I believe that was 31st of December. Even if you want to take 31st of December, I would say that's the start of the year, the 2nd of January. The Chinese market is barely down. It's basically flat. So why is it that? Because if you believe our media, or if you believe Trump and his people, they're telling you, this is going to be bad for China. We're going to crack down on China. They've been taking advantage, blah, blah, blah. So if this is bad for China, or if you believe Trump and he says China's going to pay the tariffs, how come the Chinese stock market, which is Chinese companies, why are they only down 2 or 3%, or basically flat? And the US market is down 17 or 21%, depending on whether you measure the tech stocks or the broader market. Aussie market down 15%. And the Japanese market, let's have a look at the Japanese market. How much is that down? Again, peaked in late January, or you could say the peak was in at the start of the year or the end of the calendar year. Let's take the peak from the 27th of January. Let's be a bit more fair. Look at that. Japanese market down 16%. Let's come back to the tariffs. Japan's got a smaller tariff placed on it. And now the Chinese sell $295 billion more stuff to America than what America buys from China. So that's a trade surplus for China, a trade deficit for America. So Americans are buying $295 billion more stuff from China, and politicians are trying to tell you this is going to be bad for China because they won't be able to sell stuff to America. And then the Japanese, it's only 71 billion. Now, I asked to find out its percentage of GDP. So um, the $295.4 billion of stuff that China sells more to America, it's 5.6. Now, someone fact check me if this is not good, but I've tried to use ChatGPT as best I can, rather do the research manually and go through and calculate the numbers myself because I'm probably more likely to make a mistake. But this represents a significant chunk of China's GDP, more so than Japan's GDP. Why is China flat and Japan down? That's because this is not bad for China. This is bad for the Western world. This is bad for Australia, for Japan, for Europe. The Chinese are going to be, they'll be just fine. Don't worry. Well, maybe we should worry about that, but just don't put faith in no politician is coming to save you, and government meddling in the global economy just makes everything worse. I mean, they're just messing everything up. One last quick thing I wanted to look at, and that was the Aussie financials. So it's essentially the Aussie banks. They've been in a raging uptrend, and they've shown signs of. So for those of you who think, oh, Australian property, everything's fine, nothing to worry about. Well, look at that pattern there. I mean, Aussie banks, they are they're not down as much, but they are showing signs that they've had a big run, breaking down technically, looking very ugly on the chart. Um, I don't quite know how to play that. I guess if you're bullish on Australia, Australian banks, 63% of their portfolio are loans for residential property. So if you're bullish on the Australian housing market, and I am not, I think the Australian real estate market is in a hyper bubble. But if you disagree with that statement, you think, well, John, yeah, it's a bubble, but it's going to keep going, well, then you're probably forecasting that these banks are just going to go straight back up like that. But the chart is interesting. We've looked at some similar patterns to this. Anyway, that's probably a long enough video for now, so I'll cut it off there. Time for me to enjoy my Saturday evening, 6:30 p.m. Might be time to crack a beer and try and wash away some of the madness of what's happened in the last few weeks in the markets. Have a great weekend as well. Cheers.